Hello, everyone, and welcome to episode 4 of the Lifespan Investment Series. Once again, I'm joined here by Jonathan Payne, Lifespan Investment Committee member, author, and economist, and publisher of the Payne Report. Welcome, Jonathan Payne. Good to see you again.
Thank you, Eugene.
So let's get straight into it. The big topic at the moment, or one of the big topics at the moment coming out of the US, are the recent inflation numbers that have come out. So we had a reading a couple of days ago where inflation's now come in 3 months in a row in the US at slightly higher than expected. And perhaps more importantly, inflation for the last 3 months, albeit the numbers aren't huge, inflation's gone up rather than down. So let's talk about it. We'd be eager to hear from you in terms of what this means for interest rates.
Yeah, sure, Eugene, you're absolutely spot on. We've seen a re-acceleration in inflation in the United States. We've just seen the March CPI number, and what we saw was, albeit rather marginal, but we saw a slight worse than anticipated month-on-month reading. The problem is that this is the third successive month-on-month increase that has been higher than anticipated. And what that therefore means is that the 3-month annualized rate for US consumer price inflation is now running at 4.6%. I'll just repeat that. The annualized rate of change for US CPI over the last 3 months is now running at 4.6%. You will remember that the end of 2023, US CPI was running at a 3-month annualized rate less than 2%. So the numbers are suggesting that we are witnessing a re-acceleration in the rate of inflation. And the problem with the data is if you dig beneath the headline, it gets even worse. And what we're seeing is further confirmation of a stickiness in service-based inflation. Eugene, you and I have fond memories of me prattling on 3 years ago now about owner's equivalent rent, which is a measure of US rental inflation, and how significant the rise in that was. Well, here we are 3 years later, and one of the greatest contributors to the rise in US inflation is, of course, owner's equivalent rent or shelter. And now you might also remember, Eugene, at the end of last year, Jerome Powell and many economists in our industry were trying to get us to focus on what they called super core services inflation. I'll repeat that, super core services inflation. And this is one of these wonderful little statistical tricks that our friends in the economics and central banking community play with us every now and then. But basically, they strip out everything that is necessary to live and then tell us that inflation is disappearing. Now, super core services inflation excludes food, which I think is fairly necessary, energy, and shelter, i.e. housing costs. Because, of course, they were tired of food prices rising, energy prices rising, and, of course, shelter. So they decided to create a new measure. And Jerome Powell referenced this several times last year because, of course, super core services inflation was actually seeing quite a deceleration in the rate of inflation. However, as these things usually do, they've come back to bite him you know where, and super core services inflation is now running at a 4.8% year-on-year rate. And in fact, if you annualize the last 3 months, it's in excess of 8%. So guess what? Jerome Powell won't mention this in his next press conference. And suddenly economists who were telling us that we were racing to 2% year-on-year inflation in America won't mention it either. The bottom line is we are witnessing a re-acceleration in the rate of inflation. And we all know, of course, that crude oil prices have been rising sharply, gasoline prices in the United States. We've seen recent sharp increases in copper prices. And so I'm afraid we're looking at an inflationary environment, which I think, Eugene, you and I spoke about this in 2023. The kind of easy bit for US inflation was to get it from an annual rate of 9.1%, which was the peak, if you recall. And it's going to fall pretty quickly to 4%. And then the journey was going to get much more challenging, getting to 3 and then sub 3. So I'm afraid we are witnessing a recalibration of inflationary expectations by the markets just in the last few months.
Yeah, it seems that way. And yeah, we did talk about that last year, and possibly markets have underestimated, the fact that it is probably going to be difficult or more difficult to get from around 4% to the sort of sub 3%. So if we agree that now inflation is starting to tick up again, as opposed to coming down, which is what was forecast by most, and is certainly what was driving some of the aggressive rate cut forecasts that were being put out there, even as recently as 3 or 4 months ago. We've gone from perhaps 6 or 7 rate cuts being expected 4 months ago to what, 2 at the most this year? I mean, how could you? They're not going to cut in June, surely, after this. So we're looking at it. But can they really cut rates if inflation's going up instead of down and is still above 3%? So what do you think is more realistic now in terms of what rates are going to do in the US?
Well, it's a great way you've summarized it. I agree with you, Eugene. I don't see the Fed being able to cut rates in June. And don't forget, as you just said, in January, the market was pricing 6 rate cuts in 2024. And in fact, in January, the first cut was going to take place in May. That's off the board. And then the market said, okay, the first one's going to be June. Well, that's now, I think, taken away. And I agree with you. But then we get into really tricky territory, don't we? Because, of course, we've got this thing called the US election in November. And so the calendar or the window of opportunity for the Fed to be cutting is narrowing now, because if we've ruled out May and now ruled out June, goodness me, there aren't that many meetings between July and November. So now the market appears to be saying the latest pricing is roughly around 2 rate cuts in 2024. However, a number of commentators or economists have recently said that, as following last week's CPI number, that the Fed is unlikely to cut at all in 2024. And so the Fed now faces a bit of a conundrum. And I'm afraid this is, again, why the markets took a bit of a hit following that CPI release. And don't forget also, which I know we'll talk about later, Eugene, we've got to also thread into our conversation the reality of what's happening on the geopolitical front, because that does also have inflationary ramifications. But ultimately, I think you're right. I think we can now rule out a June rate cut at the Fed, and we're kind of trying to concertina in a couple of rate cuts, but the market is now effectively pricing only 2 rate cuts for the remainder of this year.
Yeah, and which is probably optimistic, I would say, unless the data changes dramatically, say between now and June. My view is that would be pretty optimistic. And it's interesting how, markets were pricing in these aggressive rate cuts. It's now not gone from 6 to 2 rate cuts, yet equity markets have been pretty resilient, right? Like, we're a couple of percent off the all-time highs of the major US indexes and Australian index for that matter. So interesting to see how that plays out. Maybe before we talk about the recession and the prospects of a recession, you mentioned the geopolitical situation. We were discussing earlier, not a whole lot has changed in China and Europe since we last spoke 3 months ago. but a lot's happening over in the Middle East. So why don't you talk us through that, and then potentially how that could impact on things like inflation and more broadly markets, and then maybe we can circle back to the recession discussion, JP.
Yeah, absolutely. Look, as we speak, as this is being filmed, Eugene, all the other screens that surround me, which your viewers can't see, are focused pretty much on the Middle East, capital markets, crude oil markets, even a flight radar system monitoring flights in the Middle East. We are bracing for a retaliation by the Iranians for the Israeli attack on April the 1st on the Iranian consulate in Damascus, Syria, where some very senior Iranian military commanders were killed. Literally, as we speak, we're getting confirmation that the Iranian foreign minister has basically been on the phone the entire night, as all his foreign minister counterparts around the world urging Iran not to strike Israel. However, the Grand Ayatollah Khamenei has effectively issued a proclamation that there will be an attack. At this point in time, we don't know the scale of it and the specific target. What we do know, however, is the Iranians have asked the Americans to stand aside. They have explicitly communicated with the United States and said, stand aside, don't get involved. We know the USS Eisenhower aircraft carrier strike group has been positioned off the coast, and we are anticipating, and I think it will happen this weekend. It could happen in the next few hours. It could happen at some point over the weekend, but the Iranians will strike Israel. This will be the first time. So as someone who's spent much of their life occupied and preoccupied and fascinated by the Middle East, this is the most dangerous moment we have experienced for well over 40 years, because we haven't had a direct confrontation between Israel and Iran. Iran has, as you know, attacked Israel using its so-called proxy forces, Hezbollah in southern Lebanon, the Houthi from Yemen, and this one would be the first direct engagement. What does that all mean? Well, clearly the crude oil market is trying, as we speak, to calculate what is the appropriate war risk premium. Wall Street, and I'm going to be frank, and it might sound cynical, Wall Street doesn't really care about the Middle East per se. What they do care about is what the price of oil is, because that has ramifications for global economic activity and, of course, inflation. We've seen WTI, the US benchmark, and Brent rising sharply since April the 1st, the Israeli attack on the Iranian consulate in Damascus. And as we speak, we know there's a lot of call option buying in the crude oil futures market, because the market is bracing for an attack. And the market also assumes that Israel will retaliate to the Iranian attack. Now, when you talk about the Middle East and when you talk about crude oil markets, there's only really one thing that matters, and that is, will oil production be impacted? Furthermore, will there be any threat to the movement of oil through the Strait of Hormuz, which, as you know, is that choke point at the southern end of the Persian Gulf, through which approximately 20% of the world's crude oil supplies pass each day? I'm not suggesting that the Iranians close the Strait of Hormuz. If they did, then to my right, my crude oil futures chart would have to be adapted and go to the ceiling in this room. I'm not suggesting that the Iranians will go that far. However, there are geopolitical analysts, particularly Middle Eastern analysts, that I have a lot of faith in, who are deeply, deeply anxious as to what will unfold in the next 24, 48, perhaps 72 hours. Unfortunately, all of this further fuels the re-acceleration in inflation that we're beginning to see percolate through a lot of the inflationary indices. So this time, what happens in the Middle East will have ramifications for the rest of the world, and even those of us fortunate to be in Australia.
Yeah. So, yeah, terrible situation over there. But in the end, if conflict does escalate, it's certainly likely to be inflationary. Oil prices are likely to jump, and that it's an important piece of the inflation jigsaw puzzle, as you refer to it sometimes, JP. All right. So we'll all be eagerly awaiting to see what happens over there. Hopefully, cooler heads do prevail, but who knows? Moving closer to home in Australia, let's talk a bit about Australia. Let's talk about perhaps we could hear from you, JP, with respect to what inflation's doing in Australia. In Australia, we have a pretty strong economy. Unemployment seems to be staying pretty low. Yet there's talk of rate cuts. There's talk of inflation coming down, so there can be rate cuts. And then you do have a cohort in Australia that are struggling because, the cost of living has gone up, even if inflation's only running at 3 or 4%, or seemingly at 3 or 4%. Households are feeling the pinch. So, what can you say about the outlook for Australia? What's inflation doing, and how do you think that's likely to impact the interest rate outlook and the recession outlook?
Yeah, it's really quite intriguing. I think the Australian kind of economic jigsaw puzzle is a little bit confusing and complex at the moment. We have this dispersion between GDP, the headline number, which we all follow closely, and then beneath that, what we call per capita GDP, or GDP adjusted for population. All of us know that in 2023, there was an all-time record inflow of immigrants into Australia, a significant number of newly arriving immigrants into Australia, which served to boost GDP. So even though we had about a 700,000 people increase during 2023, if you look at fourth quarter GDP in Australia, it rose only 0.2 of 1%. And unfortunately, if you look back over the previous quarters, you'll see a clear discernible trend, because the previous quarter, third quarter, was 0.3, the second quarter was 0.5, the first quarter was 0.6. So there's a deceleration in the rate of growth from 0.6% in the first quarter down to 0.2% Q on Q. That's not that far from zero. However, if you adjust for population, of course, as we all know, in per capita terms, we saw a contraction in GDP in the fourth quarter of 0.3%. And in fact, over the course of 2023, we saw an outright contraction in per capita GDP in 2023 of 1%. So in fact, without that influx, that huge influx of immigrants, we would have actually seen a recession at a headline level. We obviously saw a recession on a per capita basis. Now, so that's that side of the jigsaw puzzle, and this is why the Reserve Bank's in a difficult spot. The kind of economy's just relatively flatlining. Also, by the way, productivity has been very, very poor as well. Our inflation rate now, the latest quarterly reading, has Australian inflation on a year-on-year basis at 4.1%. You'll remember the high for this cycle was 7.8% in December 2022. And of course, the government and some economists will say, oh, there you go, inflation's going away, inflation's collapsed. Well, we know, of course, that's a statistical mirage, because if inflation is rising at 4.1%, currently that is in addition to the prior increase in consumer price inflation, and consumers experience accumulated or cumulative inflation. They know that the things they're buying in the supermarkets are up meaningfully from the beginning of 2020. Consumers do not know and respond to what the annual rate of change in inflation is. They respond to the actual and absolute change in the commodity or consumer good that they're actually buying. Now, we also know, as is evidence, as we see in the United States, that service-based inflation here is also getting very, very sticky and difficult to drive down. And Michelle Bullock, the Reserve Bank governor, went to some lengths in her inaugural speech, having become the governor of the Reserve Bank, basically highlighting the stickiness of service-based inflation. And she also used this phrase, which she now regularly uses, which is not ruling in or out any change in monetary policy. So effectively, my interpretation of that is that the Reserve Bank at the moment is kind of watching and waiting, as ever data dependent, for the next set of inflationary statistics. So at the same time, we've got the unemployment, the employment situation has been very, very robust. But at the same time, the unemployment rate, as you know, is 3.7%. But I just want to read you the month-on-month change in the employment, the amount of jobs month-on-month over the last few months, to show you the extraordinary volatility in the month-on-month readings in Australian unemployment. The latest reading we have is for February, where jobs rose 116,000. Now, we're a 27 million people population. Imagine if you population adjusted that, made it equivalent to the United States. That would be like an all-time record US non-farm payroll report. So February up 116,000 jobs, January up 15,000, December a loss of 61,000 jobs, and then November was 60,000 job gain. So I'm humbly suggesting that the Australian Bureau of Statistics has a very serious problem with its employment econometric model. And I'm not going to say they're guessing, but there seems to be some serious problems with the statistical modeling of the Australian employment market. But suffice to say, the employment market is tight here. Unemployment at 3.7%. We also know wages have been rising, which is wonderful. But at the end of the day, you've got, and you said it, a significant number of Australians are really struggling with cost of living, because not only are the prices up in their shopping basket in terms of the essentials that they need every week, but also their rents are up through the roof, absolutely through the roof. Plus, they've got higher mortgage rates on their mortgages. So across the board, Australia is in a fairly tricky situation. We've got almost zero economic growth, or slightly positive, but only marginally at a headline level. Per capita recession, productivity very, very weak, unemployment market, or the employment market, very, very tight, wages rising. That's good news. However, the Reserve Bank is looking at the inflation rate and saying, gee, it's going to be tough getting to the upper end of our target band from the current level of 4.1%. So I think the Reserve Bank is going to be on hold for quite a period of time here. The market is suggesting they might cut once by the end of the year. But, you know, given what's happening with the Fed and given the stickiness of our inflation, I think the RBA is on hold for the foreseeable future.
Yeah. And I mean, we've always said that it's likely that the Fed cuts before the RBA in Australia. So if we're saying two cuts in the Fed, and we're sort of saying that's probably optimistic, then it's easy to see no cuts in Australia until 2025. Could we see rates increase? I mean, if you've got in both the US and Australia, if you've got, a strong job market as a whole, even though we've got pockets of problems, if you've got inflation ticking up, because one could argue the reason inflation is ticking up is because they didn't raise rates enough in the first place. One could argue that. I'm not saying I am. You could also suggest that some of the reason that some of the areas of inflation that have remained sticky, it's not because of rates. Like, there's only so much that rates can do. Although that's more of an argument for the goods inflation. We had supply chain issues because of COVID that impacted significantly an area of the inflation calcs. Anyway, it's all a bit academic in a sense and highly, highly complicated. But the bottom line is a June rate cut in Australia is probably very unlikely. It's probably more likely to be late this year, if you put a gun to my head and forced me to make a prediction, I'd say 2025 is when you're going to see it. And what do you think, Jonathan?
I think the Reserve Bank governor might try and squeeze one in before the end of the year. Again, don't forget, we're living in a rapidly changing world. I mean, we've got events literally as we speak, which I'm monitoring real time on these screens to my right. These events in the Middle East may well have ramifications for inflation. You've got other things happening in the geopolitical sphere. And I know we're not talking about Europe and China today necessarily, but the Chinese situation couldn't be described by anyone as being particularly positive. And Eurozone and Europe's in recession, the UK's in recession. We've got this unfortunate combination of relatively flat, stagnant type of growth, accompanied by inflation. Yes, the inflation rate has come down from the very high levels we saw 2-3 years ago, but there's this resilience and residue of sticky service-based inflation. And this is not a good combination for central banks. So, I mean, if I was at the Reserve Bank, I think, Eugene, if you and I were sitting there making these policy decisions at the Reserve Bank, I think we would fairly confidently sit on our hands at this point in time, and we wouldn't be rushing to cut rates. You actually suggested, what about the possibility of rate hikes? Now, literally in the last 5 days, a number of credible, people, sensible economists have said the Fed in the United States shouldn't even be thinking about cutting rates. They should be thinking about raising rates. Now, I'm not there yet, but I kind of understand and respect the logic of that argument.
Sure, and that's the thing about forecasting, because everything is so volatile and there's new circumstances, new facts that come out. You got to be prepared to change your mind a lot. So forecast often, and perhaps don't forecast too far in advance. Like, interest rates are really hard to predict, as we've seen. Let's not go back there. So before we move on to talking about the portfolios, how have all these issues that we've discussed today, what do you now think? How do you think that's impacted your view as to whether or not we're going to see a recession in Australia or in the US?
Yeah, I think let's do Australia first, because we could easily see a negative quarter in 2024 in Australia. If you might remember, if we go back to the end of 22 coming into 23, I said a recession in 2023 in Australia was likely. I then modified that slightly later when I started seeing the immigration numbers, and I said, look, let's accept. I mean, at the end of 2022, I didn't foresee that the Australian government would allow 750,000 people to arrive in a single year. I thought it might be 250,000, maybe 300,000. I never dreamt that we'd see 750,000 new people arriving in a single year. And I modified that view. And I basically, to me, then it was, let's acknowledge that 750,000 newly arrived immigrants are going to buy a lot of sofas, a lot of fridges, a lot of microwaves, a lot of whatever you buy when you move to a new country. So, and without that, literally without that, we would have undeniably had a contraction in the economy last year. So, look, is there going to be 2 consecutive negative quarters of GDP in Australia? I don't really know. I'm not going to say I don't care, but it's not a kind of high conviction feeling I have around that. I unfortunately still think, as we saw last year, that Australia has, the headwinds, economic headwinds are here because we've got very high levels of interest rates relative to history, got the sticky inflation, Reserve Bank pretty much on hold, and there's other drivers as well. So I'm not going to make a big flashy recession call in 2024, but I wouldn't be surprised if we saw 1 negative quarter. I think that's within the realms of statistical probability. If the fourth quarter we were growing at just 0.2 of 1%, it doesn't take much for the ABS to produce a number of minus 0.1. I'm not going to get too excited about that. The United States, okay, as I've said at great length, for those of your clients, Eugene, that suffer the pain report, aptly named. Obviously, I got the US economy wrong in 2023. I've beaten myself brutally in my written communication to my subscribers and to audiences around the world. So acknowledging again, I got the economy wrong in 2023 in the United States, notwithstanding that every single thing I looked at was telling me that there was a recession. But I underestimated the degree of fiscal stimulus that the Biden administration is unleashing, which is just staggering. But perhaps that leads me into making a couple of comments about the US market. Look, is there going to be a recession this year in the United States? Obviously, everyone is on the soft landing page now. I mean, there isn't an economist out there virtually, because those of us who were forecasting recession got a lot of egg on our face. And what we tend to do is we kind of go, oh, you know what, we're going into hibernation. I would not be surprised that we still see a significant deceleration in growth in the United States through the course of 2024. I think growth is slowing. Whether we have 2 consecutive negative quarters, I really don't know. But if I had to attach a probability in a percentage term, I'd say there's a more than 50% probability of a hard landing in 2024. I'm still in that mindset because I think monetary policy acts with long and variable lags. I did underestimate the degree of fiscal stimulus. I thought Washington would just be a little bit more responsible. Clearly, they haven't been. We're running a budget deficit as a percentage of GDP well over 6% now. That is the highest budget deficit to GDP ratio outside of wartime outside of war and also recession in American modern history. So let's just be very clear about that. So my US economic view, I'm still below the consensus, and I'm still not ruling out a hard landing in the United States. I think Europe's had a hard landing. I think the UK's had a hard landing, and I think the Chinese economy is experiencing a hard landing. And yes, I acknowledge the exceptionalism of the United States. But in terms of bond markets, Eugene, I mean, as you know, we've been having very, very lengthy conversations on your investment committee, and in recent weeks and months, really, we're basically saying, the bond market may have kind of run its course for a while, and we've become a little bit more cautious on a tactical basis and winding back that duration exposure in the portfolios. Because let's just remind ourselves, in October last year, the 10-year US Treasury note yield reached 5%. And then we saw a dramatic decline in yields, which obviously leads to a dramatic increase in prices between October and the end of December. And the 10-year US Treasury yield went right down to about 3.72% from 5% in a very short period of time. And I know that in some of your portfolios, you basically wound back duration a little bit. Now, in terms of the bond yield outlook for the United States, let's just put a couple of facts on the table. What do we know? Number one, we're running a big budget deficit. How do governments finance the budget deficit? By issuing US Treasury securities. They do that on a quarterly basis in what's called the QRA, Quarterly Refunding Announcement. Now, we know it was the quarterly refunding announcement that Janet Yellen and the US Treasury announced at the end of July 2023 that set the cat amongst the pigeons and led to a sharp rise in yields because they significantly increased the amount of securities they had to issue to finance and fund that very large US budget deficit. That budget deficit hasn't gone away. Therefore, moving forward, the CBO, Congressional Budget Office, which is a nonpartisan body, is basically saying America's got a problem. They're on an unsustainable fiscal path. They can't continue to maintain these very high budget deficits because we've already got a lot of accumulated debt from prior decades. And heaven forbid, if the United States goes into recession, we know what happens to budget deficits. They rise even more. And what the market is basically saying to the US government and the US Treasury, they're saying, you know what? If you want us to finance all this debt, you're going to have to pay us more to buy those securities. And we have this tension in the market. And I think, and I wrote this, and those clients of yours, Eugene, who very kindly subscribed to my report will know that last week I was suggesting, is it possible we go back to 5% 10-year US Treasury yields? And I think it's possible. So overnight, we traded at 4.57% on the US Treasury yield. And, and that's up markedly. Obviously, following the US CPI report, we saw quite a significant rise during the week in 10-year Treasury yields. So I'm basically now saying that I can see an environment where US Treasury yields could stretch out upwards back towards that 5% level, driven by budget deficit concerns leading to high issuance of treasuries, and also now more recently fueled by this acceleration in the rate of inflation. So that's how I'm thinking about it.
And so from a portfolio construction point of view, as you said earlier, we've become, as an investment committee, much more neutral on duration. I mean, with 10-year bond yields at around the 4.5% mark, long term, that's still reasonably attractive. But in the shorter term, we could see them going higher. Would that be fair to say, Joe?
That's a fair and reasonable characterization. Yeah. You said it in one sentence, and it took me 10 minutes.
People don't usually accuse me of being concise, but anyway. So from a portfolio construction point of view, what we did in January, as Jonathan said, we sold some duration because bond yields came down, which increases the value of bonds. We actually bought some back in February because bond yields spiked back up again. Not quite to where they are now, but pretty close. Now what we're looking to do is to actually reduce our duration exposure, because now there's kind of been this structural shift, which suggests that rates are likely to stay a bit higher for a bit longer. And so as JP said, we could see US 10-year yields go to 5% or even higher. And we'll probably see an equivalent type of move in Australia and more broadly, potentially, although most of our exposure is the US and Australia in our portfolios via fund managers. So we are in the process, almost as we speak, of making some changes, which will essentially see both our tactical and our strategic portfolios reduce the exposure to duration, moving that money into a combination of high-quality corporate bond funds, floating rate corporate bond funds. And that's significant because the fact that they're floating rate means there's no interest rate risk. So interest rates going up or down does not affect the capital value of those investments. And of course, cash, right? So we think that represents pretty good value at the moment. It's very important in our view, if you're investing in corporate bonds, to invest in high quality liquid corporate bonds, because if we do go into recession, if there is a bit of a credit crunch, they're the least likely for you to lose money on. And in fact, they could be seen as a bit of a safe haven. So that's what we're doing over the next few days. The other thing, I'm just going to refer to my notes. The other thing that we're looking to do is to replace a few managers. So in the Aussie equity space, so we're replacing the T. Rowe Price Australian Equity Fund, which is closing, with a fund called the Airlie Australian Equity Fund. Essentially, the Airlie fund's performed really, really well. And it's got a very robust and vast management team. It's had a great track record over the last 5 or 6 years. It has more of a neutral approach, which means it tends not to have a bias in terms of value or growth stocks. It just likes to pick good stocks. It has a bit of a quality bias. So they like to invest in companies that have, strong balance sheets. They're not speculative. So we're in the process of doing that. And we're also replacing an Australian Equity X20 fund, the SGH X20 fund, with another X20 fund, which is the First Sentier Australian Equity X20. X20 means they invest in Australian listed companies outside of the top 20, whereas many of the other funds in our portfolios will be very heavy, the top 20 funds. So this sort of a fund will give you that sort of exposure. Again, really good track record that these fund managers, First Sentier, have, that this particular fund has. We're very comfortable with the management. And they also have a bit of a quality bias and probably more of a growth bias, which is more common in funds that invest outside of the very big companies. So there's a few changes happening there, and they're the main changes. But broadly, we're still. The other change we're making in tactical is we've added some property and infrastructure. So until recently, that strategy, the tactical strategy, has had no exposure to listed infrastructure and listed property. So we've added, it would still be underweight relative to neutral, but we've added an exposure. Both those sectors tend to be interest rate sensitive, and given that interest rates have risen quite substantially, it probably makes sense, even though the tactical strategy remains underweight equities, it makes sense to have a little bit of exposure. We've also increased our equity exposure slightly. So the tactical strategy is still very underweight, but we have, given that, it's recession fears are probably lower than they were for us a year ago, we've sort of taken an opportunity of some of the dips in the market to try to bring that back into line a little bit, but still very underweight equities and property. On the strategic side, we haven't really changed our growth versus defensive mix in any of the portfolios, and we remain underweight. But obviously, being a strategic strategy, it's not that underweight, sort of 10 or 15% underweight. So circling back to bonds, which are the major changes that we're about to make, this will enable us to actually go and buy some more duration, if rates or if yields spike, which is what you want to be doing, because longer term, 4.5%, 5.5%, if it gets that high, is very attractive, I think, particularly when you're looking at a high quality government bond issuer with virtually no chance of default. So that's kind of how we're positioned in terms of our portfolios. So looking forward, we've talked about, I was going to say, JP, do you have any final thoughts as to the outlook for 2024? We've talked a lot about, we've sort of heard your view on recession, and we still think there's a high probability of a recession, but it's going to be very marginal. Growth GDP numbers, particularly in Australia, coming in very low. So whether they sort of cross over into negative for two quarters, consecutive quarters. So any final thoughts about the outlook for 2024, or potentially just even the next 3 months until we do our next update?
No, I think you've just done a great summation, and I don't want to I don't want to continue too much longer, because I really don't have too much to add to the way you basically summarized our thinking and our discussion today. I think, in an environment such as this, we are seeing events, particularly in the geopolitical sphere, which I'm afraid caution someone such as myself. I, as you know, Eugene, I lived 9 years in the Middle East, and it's an area that fascinates me. Probably fascinates me too much and perhaps a little bit disproportionately. But I've also, as you know, studied China for well over 30 years. And I think some of the developments and events in the geopolitical sphere, are worth noting. I will just say in closing that yesterday, the Japanese Prime Minister Kishida spoke to Congress. A wonderful speech, incidentally. If any of you have the time, I strongly recommend you either watch his speech last night or read the full text of his remarks. But let us be very, very clear that the new geopolitical order that we are now experiencing, and I've written, again, my subscribers will know my thoughts on this axis of autocracy, which I first used that phrase 10 days before Russia invaded Ukraine, which is an axis formed between Russia, China, North Korea, and Iran. If you listen to what the Japanese Prime Minister said to the joint houses of Congress, and which is a great privilege, by the way, for a foreign leader being allowed to speak to the joint houses of Congress, let us be very, very clear. We're entering a new era here.
Thank you to all of our listeners. All the best, and we'll talk again and do this again in a few months' time. Thank you.
Thank you.